Folks, he's back. You guys asked for Mr. Greg Dickerson to come back. We are in crazy times, and he is gracious enough to say, "Yeah, I'd love to come back to talk to one rental at a time." How you doing, buddy?
Doing great, Michael. Good to see you.
Nice to see you as well. So, if you don't know, we might be on the cusp of a banking crisis, and a lot of stuff going on: treasuries, Bitcoin, a lot of stuff. 12 deviation moves. But let's just go with what is Greg doing, seeing, what is going on from your perspective? The audience wants to know.
A couple of things. Nobody really knows what's going on behind the scenes, but what appears to be what's happening, obviously, is banks have invested, deposits in longer duration assets, bonds, mortgage-backed securities, things like that. They're not liquid or liquid at par value that they spent. Rates went up, so it put those assets under pressure. So when people go to pull their money out of the bank can't cover those redemptions. And Silicon Valley Bank, I think one big depositor tried to pull their money out or something, and I don't know how the word initially happened or what triggered that whole thing. But the bottom line is the banks don't keep the money on deposit in the bank that people deposit. They use
Yeah,
it to
they put it to
buy other
work. It's called
assets.
fractional reserve lending or
Yeah.
fractional reserve banking.
So what's really interesting about this versus 2008 and 9, and the other thing that's interesting is the first bank to fail was Bear Stearns, and it was this time of the month in 2008. It was March of 2008 when Bear Stearns failed, and then Lehman failed in September of 2009. So it's interesting time of year and how this is all coming down, but this is very different. This isn't a situation where the banks are insolvent in terms of the assets that they hold and things like that. They just don't have the cash to cover redemptions. So that's why the Fed and Treasury put this facility in place to kind of backstop the depositors so that banks had something to draw on to make depositors whole if people want their money back. So, really, really interesting what's going on.
Yeah, one of the things that, as you study the economy, it's all about people. Our economy, as complex as it is, and all of these, things that you want to talk about, it's all made up of people, and people make decisions. I believe the weekend that Silicon Valley Bank collapsed and the chaos that ensued, I believe that broke the consumer. And what I mean by broke the consumer is they got scared. And a scared consumer, Greg, as you know, conserves, doesn't spend. A scared consumer feels like they have to do something. So even if they only have 12 grand in the bank at a credit union, they're going to move it from the credit union to JP Morgan because it's safer. I would
Potentially.
argue I
Yeah,
would
I mean
argue it's not,
that's
but
what a
there's
lot of people are seeing and thinking. And the thing to understand is obviously deposits are covered up to 250,000. The problem was Silicon Valley Bank, most of their deposits, 80% of them were over that threshold and they were
yeah.
uninsured. So
Yeah,
that put the bank at risk there. Whereas most other banks, it's the other way around.
for
The
sure.
bulk of most other banks' deposits are insured, and there's a small percentage, 20, 30%, that are uninsured. So the other thing to understand is so back in 2008, 9, banks were failing left and right, but depositors were fine. Nobody lost their money on deposit because the banks either got taken over or they just ended up getting liquidated. But people's deposits were covered. Even when Lehman failed, nobody's deposits were at risk. That was
Even
the mortgage.
Washington Mutual, the largest bank ever, all depositors were 100% whole. Yes.
Yeah. And every year banks fail. I don't know how many, but lots of banks fail every year, so it's not uncommon. It's just interesting that it's all happening at this time, and it's obviously Fed policy that's done it. But yeah, I mean, people that pay attention and that are watching this, it's making people nervous. And yeah, why wouldn't you want to go to a Bank of America or JP Morgan or a Chase Bank, or Citi, the largest banks that are systemically important banks or systemically important financial institutions, which are deemed too big to fail. But the government came out and said, look, your deposits are good. They didn't give a blanket guarantee of all deposits everywhere. They did almost everything but that because they don't want to cause a panic. And then probably 70% of the population didn't really know what's going on. Most people don't even pay attention to this stuff and have no clue what is even going on.
Yeah. So again, I think I'm glad you brought this up. This is not 2007 all over again. This is a liquidity crisis, not a solvency crisis. Um, I guess one of the things that I see coming out of this, and it will be months, if not quarters, until we really see it, is regional banks, which is where the pain is, perform a very valuable function in their markets. They are 50% of total transactions for commercial loans. That is going to stop, at least in the short term, if not longer. And I think that's going to have ripple effects across many assets that are traditionally financed by commercial lending. What do you think?
Depends on the bank. So the healthy banks, they're still out there because they have to make money.
Yep.
So, these banks are in the business to make money. Now, what's going to happen is the rules of the game and how they make money are going to change.
Yeah,
But believe it
regulation.
or not, the local, the smaller local regional banks that are more diversified into businesses and real estate in their area are actually better off than a SVB was, or than even a JP Morgan and those guys are. Even though those banks are too big to fail, doesn't mean they're healthy. It just means they've got a guarantee that they're not going to fail. So the little banks that have their money all around now, the ones that are at risk potentially are the ones that, have office loans and things like that. I mean, pretty much real estate all across the country is underwater, especially commercial, commercial multifamily. I mean, none of it's worth what it was a year ago or 2 years ago.
Yeah.
Some residential in some areas, my area, we're still seeing multiple offers and stuff going above asking. I mean, we're still seeing that nonsense because there's no inventory.
This is not a residential problem. This is a commercial financing problem.
And that's the second shoe to drop. So everybody's like the banks, and it's neat, and it's it's in the headlines and all that. The banks are for the most part okay. The Fed, Treasury, they know how to deal with it. It's not going to be anything like 2008-9 for this. The big issue is what you just said. It's the shadow banking. So the biggest risk on banks, balance sheets are commercial portfolios, commercial loans, maybe some business loans with some businesses that are under stress, but they've worked through most of that through the pandemic. The ones that are left standing are generally solid businesses. Commercial real estate is in distress, especially in the office sector, but all assets are underwater. There's going to be a lot of disruption there. And then, equity funds, hedge funds, sovereign, debt funds, pension funds, all those people that lend in the shadow banking industry and create liquidity that's the biggest shoe that potentially is yet to drop.
I agree. The shadow banking, the non-QM, non-qualified mortgage, these other lending functions that their job is to lend, package up, sell. It's going to get tough. And
that's where liquidity can dry up fast because of redemption. So people are going to start, wanting their money back there. So those funds are going to unwind. Assets are going to get sold and spun off. Loans are going to get called. That is a 2008-9 potential, there. The question is, how big is it? How systemic? Yeah. And what will the government do about that? Probably nothing. All of that will just, so, there's a bill that's due, I mean, we've been on this super hyperinflated liquidity pump train for, multiple years now. And at some point, the bill comes due. And,
Agreed.
Like you and I have talked about many times, well, what do you do when everything implodes? Well, everybody just sits down at the table, writes it down, and you start the cycle over again. So the banks are one thing because you need the banks, that keeps the economy humming. So they have to protect the depositors of the banks.
Correct.
These other entities, they can just get written off and wiped out and nobody cares because they're just going to work through their cycle anyways. But that's where the damage can be done to the economy because, that's layoffs, that's people out of work, that's, economic activity that's, draining the cycle, and that can last, for a number of years. So that's what I'm watching more than the banks.
Yeah. The one area I will throw on this, and this is definitely probably because I'm a Silicon Valley guy. I think there's equally amount of pain in the private equity, startup business, just like the commercial loans. There's a lot of loans done, a lot of capital raises that were done at stupid valuations. You just saw Stripe do a down round from 95 billion to 50 billion, plenty of down rounds coming. And more importantly, there will be companies that cannot do a next raise and they will just go out of business. We are in the Silicon Valley, the tech world, we are going to see layoffs. Now, again, these aren't layoffs immediately because they have a burn rate. But we are going to have some startup pain Q3, Q4, Q1, in my opinion.
Potentially, and we're seeing a few of them now. But the thing is, with the layoffs that we're seeing now, they're at the white collar level for the most part, higher level tech employees. They're getting severance. They're getting, benefits when they walk away. So they've got time that they can hold out. And a lot of them already had other jobs anyways, or can get other jobs quickly if they want to, because for every job that's laid off, there's still 10 more out there that are available, potentially in that world. And then when you start looking at, the real job market that makes a real difference in terms of a recession, that's your, manufacturing sector, your construction sector, your service industry. I mean, that's the bigger component of the economy where a real recession can set in, and that market is still way too strong. So, the interesting thing is, is that where and maybe we talk about this in the next video, is the Fed's decision, what they're looking at, those things are all coming into play. It's going to be very difficult for this, I mean, it's just really interesting, difficult times because of the dichotomy in the labor market right now. And, it's kind of like the housing market, there's no inventory, there's no workers, for all the jobs. So it's going to stay elevated.
Yeah. So when you look at this banking crisis, again, I think we both agree this is not kind of the Great Recession on repeat. It's something different. I have done research and think it's similar, at least akin to the savings and loan crisis, kind of the same ilk. So I've challenged people to go do some research about the savings and loan crisis. What do you think about that? Wise advice?
Yeah, absolutely. And the real question is this going to change the business model for the banks? Because it used to be the banks were somewhere you just kept your money. It was a boring business and they didn't do a whole lot with deposits, right? Then this whole levered up thing and buying these instruments and just derivatives and swaps and all these other things, that's where the banks really started making big bucks, especially the big, too big to fail banks, the ones that are getting the billions of dollars in bonuses and, hundreds of millions in salaries for the executives and all that. I think the banking business model now this is the closest it's ever been to a fundamental change in the industry, to where it gets back to basics, back to fundamentals, not going to be allowed to lever up, changing credit controls, the things that they can do, and, liquidity requirements, reserve requirements, things like that. So it'll be interesting to see what else happens and, how that evolves as we go through. But, banks are still lending. Are they going to change? Is it going to get tighter? Is it going to get more difficult? Depends on the bank, depends on the area, because every bank's doing different things. So, banks are still lending out there right now today for, for certain things. And then there's other ones that are pulling the plug. So, you got to go shopping.
Folks, as you know, Greg Dickerson has an amazing playlist on this channel. You need to check it out. But if somebody wanted to follow you, reach out, Greg, how should they follow you?
Yeah, gregdickerson.com. I got the YouTube channel, still putting out daily videos on the economy and markets and things like that. So go check it out.
Awesome. Thank you so much.